Middle East tensions are dominating global headlines, with Asia among the most exposed regions, and Vietnam is not immune. That said, the country's direct exposure remains manageable. Vietnam can self-supply around 20% of its crude oil needs, while authorities are actively reinforcing energy security by boosting domestic output, prioritizing local fuel supply, and temporarily reducing petroleum taxes to ease inflationary pressure. At the same time, supply diversification is underway through new energy agreements, including with Russia, alongside short-term support from China. The power sector also remains relatively insulated, as imported LNG accounts for only about 2% of total generation capacity. Encouragingly, Iran is facilitating Vietnamese vessels through the Strait of Hormuz, highlighting the benefits of Vietnam's neutral and pragmatic foreign policy. On the macro front, growth remains solid. Vietnam recorded the first quarter GDP growth of 7.8%, supported by industrial and service sector expansion. Industrial activity rose 8.9%, driven by manufacturing and construction, while services grew 8.2%, with trade, transportation, and retail contributing positively. So far, the impact of the US-Iran conflict has not yet materially impacted economic growth, though some moderation may emerge in the coming quarters as external pressures gradually filter through. Inflation is beginning to reflect these dynamics. CPI rose to 4.6%, mainly driven by transportation costs, which increased by over 10% year-on-year due to higher oil prices. Housing and construction materials also recorded price increases, reflecting broader cost pressures linked to elevated energy and commodity prices. Looking ahead, assuming the Strait of Hormuz reopens by end April, we expect Vietnam's CPI to remain around current levels through year-end. Retail sales delivered a mixed signal, growing 10.9% in the first quarter. Tourism was robust with 6.7 million international visitors in the first quarter, though momentum slowed in March as higher airfares weighed on travel demand. On a more positive note, domestic consumption showed signs of improvement after a relatively soft start to the year. Excluding the price effect, retail sales still recorded real growth of 7% in the first quarter, in line with 2025 levels. Going forward, consumption may face some pressure from rising inflation and softer tourism trends. FDI disbursement reached $5.4 billion, up 9.1% year-on-year. A notable development is the approval of the Lien Chiu Deep Seaport project in Da Nang, with total investment of $1.76 billion, underscoring continued confidence from international investors. Public investment also increased by 12.1%, with infrastructure projects remaining the main driver, although progress has moderated somewhat due to rising input costs. Manufacturing activities remain expansionary. PMI came in at 51.2 in March, marking the 9th consecutive month of expansion, but firms reported rising input costs and longer delivery times. Trade activity remained robust, with exports and imports increasing by 19.1% and 27% year-on-year respectively, resulting in a trade deficit of $3.6 billion, which we attribute to inventory restocking demand and precautionary purchases of raw materials amid concerns that geopolitical uncertainties could drive input costs higher. Vietnam has finalized key leadership appointments, with To Lam assuming both the roles of General Secretary and President, while Minh Hung has been appointed Prime Minister, and the Chairman of the National Assembly continues into a new term. While the consolidation of the General Secretary and President roles has raised questions about a potential shift away from collective leadership, the practical impact is likely limited, as the President's role remains largely diplomatic with minimal involvement in economic policy making. Importantly, the broader leadership structure remains intact. The presence of Tran Sam Tu as standing member of the Secretariat helps preserve the functional balance of the traditional four pillars, suggesting continuity in policy making and execution. Vietnam's stock market has reached an important milestone, with FTSE Russell upgrading the country to secondary emerging market status, reflecting ongoing improvements in market infrastructure. A key change is the new mechanism allowing foreign institutional investors to route orders via global brokers without opening local accounts, removing a major barrier to entry. We expect foreign participation to increase from September when the upgrade takes effect, with estimated inflows of around $3 billion to be deployed in phases. Despite this positive development, the market declined 10.9% over the month as global uncertainties resurfaced, triggering a risk-off sentiment. Tensions between the United States and Iran raised concerns over slower growth and higher inflation, while rising deposit rates reduced the relative attractiveness of equities. Liquidity remained stable, with average daily trading value at around $1.2 billion. Foreign investors recorded net outflows of $667 million, bringing year-to-date outflows to $1.2 billion. Although selling was concentrated in Bing Group-related stocks, $576 million, and FPT Corporation, $362 million. All sectors declined, with financials and real estate underperforming due to higher interest rates, which may pressure asset quality and housing demand, particularly in higher-end segments. The information technology sector fell 19.6%, mainly due to FPT, where foreign selling reflected both fund outflows and concerns over AI. We think these concerns are overstated. AI can improve FPT's efficiency and support order growth, as reflected in a 21% year-on-year increase in new signed contracts in the first 2 months of the year. The stock is trading at around 12.2 times 26 forward price to earnings, with a PEG ratio of 0.7 times. Overall, while short-term volatility remains, structural improvements such as the FTSE upgrade continue to support. Our portfolio declined by 10.5% in March, compared with a 12% drop in the FTSE Vietnam index. The conflict between the United States and Iran triggered a broad-based market correction, erasing gains from the first 2 months of the year. Year to date, the portfolio is down 3.9% compared with a 10.9% decline in the reference index. We are currently reviewing earnings across our holdings and will provide more detailed updates in our first quarterly notes. Looking ahead, the market is likely to remain sensitive to global developments, although volatility may moderate as many investors have already reduced leverage. That said, sentiment can still shift quickly as new information emerges. The VN Index is currently trading at around 11.9 times 2026 forward price to earnings, based on earnings forecasts that largely reflect pre-conflict assumptions. This represents a discount of about 20% compared with Southeast Asian peers, suggesting that part of the risk has been priced in. With the upcoming annual general meeting season, investors are expected to gain clearer visibility on how the conflict is affecting corporate performance, which could help support confidence. In addition, the upcoming FTSE Russell upgrade to secondary emerging market status is expected to provide a more supportive backdrop for market sentiment